You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Welcome to Retirement Friday. I hope that you're doing well. And today we're going to talk about how to withdraw from an All-In-One ETF at retirement. That question actually came from Andrew on YouTube. So just want a quick note. If you're listening to The Moose and the Loose and you want to interact with me or ask any questions or be featured for a full episode like Andrew just did, you just go on YouTube, the Dividend Guy on YouTube, and all The Moose and the Loose are there as well, on top of like a weekly videos on every Thursday. So just more content for you guys. And if you are interested in asking any questions, just go there, ask the question, and if you're lucky, I'm gonna find it an interesting one to spend 10 minutes on. So there you go. So first, All-In-One ETF. Why would I suggest to go into an All-In-One ETF at retirement? Actually, that's, again, not financial advice, but I've been thinking about this. I love managing my portfolio. I love having stocks in my portfolio. And you know me, I prefer to have stocks than ETFs, even though ETFs are doing a great job. So I'm not saying that ETFs are bad. It's actually just a matter of like, I like to have the control and know exactly what I own and why I own it in my portfolio. But I've thought about that because one day I'll age a little bit more, right? We cannot stay in our 40s forever. And my wife has absolutely no interest in managing a portfolio, no knowledge about that as well. And therefore, I need to find kind of like a backup plan. And having an all-in-one ETF sounds to me like one of like the perfect solution. Like not perfect in the sense that it has some flaws, of course, but it's an easy one, like super straightforward, easy to explain. You have like one line in your portfolio, like a single asset. You have all your money in it, but that line is redistributed across thousands of companies, thousands of bonds if you want to have like something with bonds and stocks, and you can select the volatility level that you want. So you can have like something half and half, so 50% bonds, 50% stocks. You can go all in stocks like XCQT, for example, but then iShares and Vanguards are offering all-in-one ETFs from like 20% in stocks, 80% bonds, all the way up to 100% stocks, nothing in bonds. So you can select the one that fits your risk tolerance, your objectives. You have one line. It's well invested across multiple sectors, multiple countries, multiple companies, and it's being rebalanced automatically. So that's the first thing that I love. So Andrew's question was, okay, so you're at retirement, you have $1 million, you invest everything in XCQT, for example. So how do you generate your monthly cash flow? I need like $5,000 a month. Like, how do I do that? Well, first things first, you need to, it would probably be better to have like a cash reserve, right? Because having just the All-In-One ETF, especially if you're heavily invested in equities, well, a year like this year, you're not going to smile if you're about to sell some of your ETF shares at a lower price than they were trading at January, right? So you don't want to be exposed to that sequence of withdrawals where you enter into a market correction, or even worse, the bear market, where your portfolio is down like 20 or 30%. You don't want to sell shares at this point. So I would have the All-In-One ETF, and then I would have a cash reserve. So I would withdraw money from the cash reserve, and the cash reserve could be invested in a laddered bond ETF, T-bills, a GIC ladder, like something like very, very safe, and have enough liquidity every year to generate some income. Speaking of income, before we continue on this episode, I have reviewed 20 income-focused products for retirees at moosemarkets.com/retirement. You can download the guide. I reviewed like those 20 income-focused products, one page per, with pros and cons, like totally non-biased. I really wanted to highlight everything that is great about those products, everything that is not so great, so you are in a better position to make the right decision for you. So moosemarkets.com/retirement. You put in your email, you register the newsletter, and you get that guide for free right there. The follow-up question from Andrew was actually, how about we split into multiple ETFs? So having like a basket of ETF that you manage yourself. Instead of having an all-in-one ETF, you could build your own kind of like all-in-one ETF. So therefore, you increase your level of control, because one flaw with the all-in-one ETF is if you don't want to have, like, for example, 45% of your money invested in the US market, well, you cannot invest in XQT because this is what they offer. So you have, you can build your portfolio of ETFs, so you have more control. On the downside, it's going to be a bit more complex. Thinking of having this multiple ETF, what I would do is I would actually sell some of like the bonds laddered ETF to generate the income. That would probably be better. Or you can have like a bond ladder ETF. You can do it with a cash reserve, as I suggested before. But that could be the easy way out, where you can generate that income every month or every quarter if you want to minimize transaction and keep it a little bit more simple. You could sell like a larger chunk every quarter, so you just do like 4 transactions a year. But at the end of the year, you'll have to rebalance. Actually, you'll have to rebalance on both sides, right? Because if you have an all-in-one ETF, the all-in-one ETF will rebalance itself. But if you keep on withdrawing money from your cash reserve, well, eventually that cash reserve is going to run dry. So on good years on the market, you would have to still sell a little bit more of all-in-one ETF. Or if you have multiple ETFs, you would have to sell all your equity parts, trim a little bit to put the money back in the cash reserve, or put the money back into like that bond laddered ETF, like something safe, as I said, safe, stable, liquid. That's like the goal of having a chunk of money there so you can withdraw regardless of what's happening on the stock market. Because when the market is down, you don't want to sell your shares and suffer from the sequence of withdrawals, because at that point, that could put your retirement in jeopardy, and we don't want that, right? We want to live a happy retirement. We want to not think about money when we are retired, and we actually want to enjoy life. So that's the whole point. So you really have to rebalance in both sides. The way I would do it is simple. You have a good year, like 24. At the end of the year, you sell a little bit more of your equities, like all of them, not just the best performing. What you do is you rebalance your portfolio based on what you're supposed to have. So if your goal was to have 40% invested in the US market, and at the end of the year you're at 50, well, you know what to do. You sell 10% of that, and then you re-inject this into your cash reserve, or you just rebalance your portfolio. Same thing for Canadian equities, same things for international, same things for everything. And on a bad year, you rebalance to just get the same asset allocation if you're not into an all-in-one ETF. But preferably on a bad year, what you do is you get the money from the cash reserve. So it's important to have like maybe up to 3%, 3 years, of cash reserve. Like, you're going to generate some dividends, but besides that, you need about 3 years of cash reserve to be able to fully recover from a general like bear market. So on average, when we say bear market, is when a market is down at least by 20% from its peak value. And the average time of recovery, so going back up, recovering that 20% loss, takes about 18 to 24 months. Of course, you have bigger crises from time to time, so the 3 years would not cover those, but would cover you for a long while still. So it's kind of like the best of both worlds. Instead of having like 5 years of cash reserve, which, unless you have a lot of money, that could hurt your retirement plan, because you're going to lower your expectation as well. So the key points here when you're thinking about all-in-one ETF or a packaged ETF that you run yourself, you want something that is simple and easy to explain, like very straightforward, so you can manage it as you age, and your spouse, even with little interest, could do it as well. Always include a portion of your portfolio that is protected against the market. First, to meet your risk volatility, you don't want to panic. And second, to ensure that you have enough cash and you're not forced to sell at a bad time if you are willing to take more volatility and invest in the market. Number 3, rebalance. Like rebalancing your portfolio, making sure you follow, again, that simple and easy to explain strategy to have the same asset allocation at all time to replenish your cash reserve as well. So rebalance every year. So first, simple and easy. Second, a portion of your portfolio protected against the market. Third, do not forget to rebalance. So don't forget to grab your copy of the 20 income focused products. I'm sure you're going to learn a ton from those at moosemarkets.com/retirement. So moosemarkets.com/retirement. And we're going to talk again on Monday. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.